Good morning. My name is Aditya Pattanaik. I am an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 1st of August 2024. We cover various topics that are relevant for investors in the gold, silver, uranium, nickel, and rare earths markets today. These topics follow on from discussion points that were raised at the Rule Symposium in Boca Raton in July. Please contact me via email if you have any questions. I've often heard you say that in your experience, major global markets have followed periods when the general populace starts getting worn down by an accelerating decline in their purchasing power, or when the realization of inflation really sets in the population. Now, some of the views that were presented at the symposium were in favor of this argument that we are in an environment where monetary inflation is being actively pursued over austerity to address the issues that the advanced economies are facing today in terms of unsustainable debt levels. There were others at the symposium who disagreed with this idea and who believe that the Fed in the US is already late with cutting interest rate because they do not believe that we are in a period of higher structural inflation. And I know you've talked about how much weight you put into this number, but they are saying that the direction that is being observed in the CPI is real. I'd like to get your views on whether you agree or disagree with some of the ideas that were shared at the symposium on these two topics.
I think the natural direction of pricing in an over-encumbered world is deflationary, is accurate. But I think that deflation is so politically unpalatable that the response to deflationary pressures will be very inflationary. I also, as you suggest earlier, believe that inflation as measured by the CPI is irrelevant. It's relevant in the sense that people assume it's important, which is to say it's a classical factoid. It isn't a fact, but it's believed to be fact. Core prices, excluding food or fuel. I mean, how can that be useful? A measure of inflation, which from my point of view is useful only in determining your cost of living, where that measure doesn't include the cost of government, which is 43%, I think, of the average household budget, is silly. What I think, as an investor, as a citizen, and in particular as a student of the gold market, the relevant statistic is the delta between the true depreciation of the purchasing power of a fiat instrument, in this case the US dollar, and the interest rate available on the core savings product, which is the US 10-year Treasury. I call that the real rate of savers' interests. If you believe, like I do, that the deterioration of the purchasing power of the US dollar for the basket of goods and services that I consume, which sadly includes government, is 7.5%, then if I buy the US 10-year Treasury at 4.4% or 4.3% or whatever, I'm guaranteed a negative real yield, which is what makes gold attractive to me.
Jerome Powell spoke yesterday, and he expressed at least intent to start cutting rates in September. If you believe in the stickier inflation viewpoint, do you think it is a mistake for them to be cutting interest rates then?
I do. I think they're participating in interest rates at all is a mistake. I think that you should have a free market in money, and I think that the market should determine interest rates. From the point of view of a gold speculator, and in particular a gold stock speculator, I believe that I will benefit mightily from Mr. Powell's mistakes. I'm reminded of the period 1974, 1975. The gold price rose from a price-controlled $35 to $200 per ounce. In 1975, inflation was coming to be a matter of public concern, and the Fed tightened interest rates, raised interest rates, which caused the gold price to fall from $200 an ounce to $100 an ounce and impacted demand for consumer goods, for new home starts, for bond markets, for the equity markets. Towards the end of 1975, the Fed lost its nerve and cut interest rates. And that interest rate cut, in the face of continued persistent inflation, generated a bull market in gold that took the material from $100 an ounce to $850 an ounce in 6 short years. I'm not suggesting that we will see that dramatic a price readjustment in gold from a cutting in interest rates, but I do think that a cutting in interest rate will signal to the market that the Fed cares less about individual purchasing power and much more about the manipulation of the political economy. And that declaration of intent will have a positive impact on gold and later gold equities markets.
I wanted to talk about this chart in particular on the subject of gold. This is essentially the ETF flows. The chart on the left is the annual flows from 2005.
Yep.
And the chart on the right is the quarterly flows. At the time of recording this discussion, the price of gold is north of $2,400. But the sentiment in the gold market, if you look at it from a fund flow perspective, particularly a Western fund flow perspective, still feels very tentative. In a sense, it is somewhat puzzling. One of the things that really stood out to me in this chart was that the inflows and the outflows seem to cluster in a time frame measured in years rather than weeks and months. And we've just been through 3.5 years of outflows, and there are very early indications that we're returning to net inflows, at least in terms of the Western investors. Given what you just mentioned about the 70s, I was interested in your views on the nature of how this bull market is progressing, where we have new participants in the Eastern Hemisphere, but we have participants absent in the Western Hemisphere. We have high prices, but we also have a very tentative market on the equity side. So I was curious, based on your previous experiences, on whether you see this as an early stage of the bull market or whether you see something different about its nature.
I continue to believe that retail investor behavior in the West is a function of having existed through 40 years of fairly benign economic climate, the period 1982 to 2022. A period characterized by good demographics, by the positive impacts of globalization, by declining real and nominal interest rates, and by U.S. dollar hegemony. What that meant was that gold that does well in times of fear did poorly because there was very little fear. And I believe that the investor appetite and investor perceptions were set over 40 very good years in the economy. It reminds me a bit about my studies of the late 40s, the 50s, and the 60s. Again, a period of very benign economic climate, particularly for Americans, where there was no interest in gold whatsoever. I would argue, in fact, that the perniciousness of inflation, that the sense that there was change occurring in the period 1967 to 1973 didn't impact investor behavior very much at all. It wasn't until the investor came to understand the impact of inflation on his or her pocketbook, really, through 5 years of compound decreases in purchasing power, that the sense of inflation began to change investor behavior. And I think that living through 40 years of benign economic climate in the West has done the same thing to Western investors. It's useful to note, Aditya, as you pointed out, that the buying that we've seen in the gold market, at least until the last 13 weeks, was really dominated to a large extent by foreign central banks, and to a lesser extent by retail buyers in the East. And it wasn't until very recently that we've seen any inflows into gold-oriented ETFs at all. To me, this is likely fairly bullish, although it may take a while for this bullishness to take off. It also explains away, I think, the delta between the performance of gold and the performance of the gold equities. Explains it in the sense that the bid for gold for the last 2 years, 2.5 years, has come from foreign central banks. And foreign central banks don't buy stocks, they buy gold. It makes perfect sense that there wouldn't be correlation in asset classes when the buyer's intentions were all expressed in one market, not two markets. If we begin to see more retail participation in the physical gold market, I think that the delta between gold and the gold equities will become less pronounced.
One of the things that surprises me about this is that the last 3 years have taken place when this was happening, in terms of inflation in the West. What do you think has kept Western investors? Is it just interest rates, or what do you think has kept them away from gold?
I think three things. One, the attitudes that were formed over 40 years will change if the trend in motion continues. I can't tell you when they'll change, but I do remember the period 1967 to 1972 or 1973 were noticeable for the same type of quiescence around the deterioration of purchasing power. It is also true at that point in time that there was less overt manipulation of the interest rate. There was a control at the federal level of deposit interest rates, which is to say there was an indirect regulatory subsidy of banks and savings and loans by a price cap on the interest that they could pay depositors. There was no such cap on the U.S. 10-year Treasury. So at the beginning of the decade of the 70s, the interest rate paid on some competing savings products, and certainly the interest that was beginning to be charged in the bond market, compensated some investors for the inflation that they were suffering in other places. That seems to be less evident today, although the bond market has certainly suffered in the last 3 years. My suspicion is, and I'm, as I say, not a scholar of market psychology, that the perniciousness of the deterioration of the purchasing power experienced by savers and wage earners will begin to impact their investment decisions. And I think it's important to note, Aditya, that those charts that you have posted, while they're dramatic in the context of the gold market, don't take into account how small the gold market is. The market for precious metals and precious metals related securities, according to JP Morgan Chase, the market share of that asset class is less than 0.5% of total savings and investment assets in the United States. So the flows that these charts track relative to the flows in the broad economy are completely insignificant. I mentioned that because if investor sentiment and perception changes, relatively small changes in asset allocation can generate enormous moves in the gold price. The 4-decade mean market share of precious metals and precious metals related assets, according to JP Morgan Chase, is 2%. If we had a reversion to mean from 0.5% to 2%, the numbers that you would see on this chart measured against 100% of the savings and investment assets in the United States would be radically different.
That leads me well into my next question on the miners, specifically on the valuation of the miners. One of the things I do note is that the intermediate and junior producers are trading at a significant discount to the historic averages for the sector. This brings me to a question that is related to something that you've just said about the market, where if you look at it over a 40-year period, there hasn't been the same level of participation in the market for a long time. And the gold miners enjoyed a certain premium from the 80s to, in fact, till 2010, which they have completely lost in a sense, and they're trading at a significant discount over the last 15 years. So, is this a function of what you were saying about missing participants in the market, or is this a function of the efficiency and the profitability of these companies in general?
Yes and yes, Aditya. I think the overvaluation, the relative overvaluation of the sector that occurred for 25 or 30 years was a hangover related to the incredible performance that they generated in the period 1967 to 1981. I think the underperformance that you see in the sector is a function both of reversion to mean and poor performance. The industry was hopelessly overcapitalized for a very long time, had a very, very low cost of capital, and as a consequence, wasted the money. The other thing that the chart on the left represents is the increasing prominence of index and passive investing. Larger companies now increasingly enjoy more trading liquidity, higher share prices, and a lower cost of capital. So that cash flow is not accorded the same valuation. It has also come to the market's attention in extractive industries that single asset producers are inherently riskier than multi-asset producers, because you can have a bad quarter or 2 quarters in a single asset producer and actually jeopardize their debt service capability, while a multi-asset producer can coast through periods of time. So I think the outcome of this will be consolidation, where the single asset producers that aren't able to build a market constituency will be acquired and de-risked by multi-asset producers, at the same time that there will be a bias in the gold mining industry and in other industries to amalgamate and form companies with larger enterprise value, inclusion in more indexes, and as a consequence, more index and passive buying. I think that is a factor that changed in the market fairly dramatically in the last 25 or 30 years. More and more investors are in the market, either institutionally or as individuals, in indexes and ETFs, and there is less prominence to individual stocks. And I think the market, in terms of capital formation, is taking that into account.
As a follow-up to my question about the discounted valuations that some of these companies are experiencing today, I came across an interesting chart that was posted by the CEO of Pure Point Uranium. So this is not a chart I made, but this is someone from within the sector, and they're obviously pointing out something that has affected their own share price more than the others, because they are an exploration company. But what they are saying is that over the last year or so, the spot price has done quite well. The producers have done quite well. The developers have, as a group, have underperformed both spot and the producers, and the explorers have done the worst of the lot. In 2020, when we were talking about this, one of the things you said is you were surprised at how it was a rising tide that lifted all boats at the same time, rather than in a staged sense where you saw money flowing from the royalty companies down to the explorers over a period of time. When you look at a chart like this today, whether it's in the uranium sector, and I think it's very similar as well in the gold sector, part of it has to do with the passive flows that you were talking about. With the explorers really not participating in that at all. Do you view this chart as an indication of where we are in the bull market, or do you view it as more as the fact that these sectors, based on the lack of capital investment, just don't have quality opportunities sitting down in the higher risk segments of these markets?
Sort of all three, Aditya. I see this chart as very rational in terms of where we are. The immediate beneficiary of an increase in the uranium price is the producers. Neither the developers nor explorers have uranium for sale. It makes perfect sense that if the price of something you don't have any of goes up, it doesn't accrue to you. The developers at least threaten to have value. While they can't capture the price increase today, they may be able to capture the price increase 2 years from now, 3 years from now, 4 years from now. The explorers, aside from sentiment, are not really a function of the uranium price, but rather a function of their exploration success. And until they demonstrate exploration success, it makes perfect sense that other than from a sentiment point of view, they wouldn't be attracted to uranium. One thing that I need to point out with regards to this chart is I think it's going to begin to change in a way that's unique to the uranium market. Because of the advent of term contracts in uranium, so that the developers can enter into offtake agreements for 5 years, 10 years, 15 years, or 20 years with investment grade counterparties. The cost of capital, debt capital for uranium development, and the accessibility of capital for uranium project development will be better than it is for any other natural resource sector. And so I personally would expect outperformance among the developers. Outperformers, too, because traditionally junior companies didn't have access to the capital to develop their projects, and as a consequence had to sell out to larger companies. The competitive tension that will be introduced into the market as a consequence of increased availability and the lower cost of capital means that takeovers that occur will have to take place at larger premiums because they're competitive. There's competitive tension. So I think when you look at this chart, you have to be a bit forward thinking about the way the structure of the uranium market has changed and who benefits and how those benefits take place. I think that if we return to a crazy bull market where narrative trumps arithmetic, that the best participants, or rather the most exaggerated participants, will be the explorer, since they have no value, and right now they have no narrative. When narrative comes into the market, to the exclusion of everything else, the nature of a blow off top is that the most marginal participants in the sector outperform the more logical participants in the sector. So one hint that we will have revisiting this chart in the future, if we're in a uranium bull market, will be the decided outperformance of the most marginal participants in the chart relative to the other categories in the chart. This is irrational. This is a rational rather than an irrational chart for where we are at present in the market.
I think you've in the past mentioned that outside of uranium, silver, in terms of upside, is one of the most volatile commodity segments out there. And as you know, I have a large number of clients that are involved in the silver market. And some of these clients are also positioned more on the narrative side of the market. Now, one of the questions that you did ask the panelists at the symposium when you hosted the silver panel was how they think about the price of silver. Was anyone on the silver panel able to give you a good answer about how to think about the price of silver from here on?
Good is subjective. And I was disappointed in the answers I got from my own panel, not because I disagreed with them, but because I didn't think I learned much from the panel. I think silver is unique in the sense that silver does go to silver heaven. You know, it gets used in solar panels, which are not efficiently recycled. It gets used in industrial processes around water and wastewater purification. So it gets used in electronics and microelectronics. So in fact, unlike gold, silver gets used, and the deficit does matter. But it's important to know in terms of price performance that investment demand matters much more. If silver were an industrial material, silver companies would be valued at copper or tin or zinc cash flows, which is to say 5 to 7 times EBIT. but silver companies are valued at 14, 15, 16 times EBIT, unless they happen to be silver streamers, in which case they get valued at sometimes 20 times EBIT. So clearly, from the perspective of price performance, what matters is the impact of marginal demand over the amount of silver that's for sale in the investment market at that price point. And I didn't hear anything on the panel that would have changed my mind as to that. The reason I asked the question, Aditya, is that while I have a real memory of what occurred when silver moved, I've never understood personally why it moved. I just understood that it moved. And I was hoping that somebody on the panel who had thought about it from a different perspective could help me with that. I certainly remember the move in the decade of the 70s when the silver price went from $1.50 to $50. I remember the move 2000 to 2010, 2011. I know that precious metals bull markets are led by gold. Irrefutable fact. When the momentum is established by gold, if that momentum becomes to be adopted by more generalist investors, then leadership changes to silver, and silver moves further and faster after the momentum has been established. I don't know why. I theorize that it's because it has a lower price point, but it could also be as a function of a factoid, which is to say it happened in the 70s, so it happens again because people expect it. I don't know. That was the nature of my question. And frankly, I didn't get a satisfactory answer.
One of the reasons I ask you this question every time we speak about silver in terms of thinking about its price is because as an investor, you are trying to come up with a net present value and a PNAV for a silver company that you're investing in. In 2020, those, including myself, who held onto their silver stocks, suffered 3 years of a downtrend. And I'm trying to figure out a way to avoid riding the cycle down again. And it is very difficult to come up with a valuation if you don't have a number where you feel the market is overvalued. What are your views on that?
My view on that is that I suffer from the same conundrum, which is to say, I don't know how to value it, and I don't know how to, with any degree of comfortable certainty, forecast in the future. So what I do with regards to that is position sizing. I have now lived through 4 extraordinarily productive silver cycles. And I've had really a number of silver stocks that have paid me stupidly well over fairly brief periods of time. But because of the uncertainty as to why it happened or how it happened, I have limited my exposure to silver to about 2.5% of my overall portfolio. I own it because I believe if we come into a silver cycle, and I say that it's a probability, a weak probability, not a possibility, but it's still a probability, and I can't say when. If that's caused to occur, it is possible that 2.5% of my portfolio could be 25% of my portfolio. If I'm wrong, and that 2.5% of my portfolio goes to 1% of my portfolio, because of the fairly de minimis portfolio position it occupies, it won't change my decision as to what to have for breakfast. If, by contrast, it goes from 2.5% of my portfolio to 25% by organic means, that would make a difference. I'm attracted to it not because of the certainty that it offers, because it doesn't offer certainty, but merely because of the juxtaposition of the potential upside to the potential downside. And I manage the risk personally by portfolio sizing. I also, frankly, in 2020, looked at the fact that the more speculative names greatly outperformed the high quality names, much like we just talked about with your uranium chart. And I took that as a signal myself to sell some of the more speculative names. Now, unfortunately for me, I recycled that money into silver itself and the higher quality silver names, which meant that I still suffered a loss, although not as significant a loss as I would have suffered had I continued to hold the gamier names. The in me, the leadership rotation from the highest quality participants to the lowest quality participants is the best signal that I have that the market is getting frothy and it's time to begin to take my exit.
I would like to move on from precious metals and talk about some of the other commodity groups that were present at the symposium. One of the things I've heard you say in our previous conversations is that when the reason for owning a stock goes away, you will sell the stock as well.
Yep.
A change in sentiment and price in the underlying commodity can have a very dramatic impact on the share prices of these companies. We're seeing this with nickel and lithium stocks today. A lot
Yep.
of these stocks have lost 50% of their market capitalization over a relatively short order. I was speaking to some of these companies at the symposium. So it was quite interesting because as a contrarian, you are attracted immediately to these companies, given that nothing has really changed at the fundamental level. I know you are a contrarian investor, but how do you deal with the volatility associated with commodity groups like nickel and lithium in terms of your own investment decision-making process, given the time value of money and equity dilution of riding these stocks down for a few years?
In terms of time value of money, Aditya, I've done a bad job. I'm always early. And if you discount your money at 10%, which is what I do, my implied inflation assumption plus 250 basis points real return, it's arguable that if you are as early as I was on the uranium market, that you aren't early, you're wrong. So I need to beg off from a time value of money perspective and say that I do a bad job of that. Um, with regards to dilution, I have done a great job over the years at forecasting the amount of equity that the companies will need to raise to stay alive. And I have done a pretty good job of trying to participate in these companies when they do the save the company financing, that last gasp financing that is always the most generous of the financings. I think, too, with specific regards to nickel, that one of the things that attracts me now is the fact that the nickel producers are in such disarray that there's absolutely no capital attraction to the developers, despite the fact that the developers will have projects which will come into production 3 years from now, 4 years from now, 5 years from now, which is to say the malaise that impacts the current free cash flows of the producers won't affect them. I don't have any idea when the nickel price will change, but I do note that at least with regards to the lateritic nickel production, that you are seeing prices low enough that you are seeing the scrapping, sometimes even the cold scrapping of productive capacity, which is a great first sign of a market turnaround. So my attraction, as an example, to names like Centaurus, and this is not an investment recommendation. I'm very different from most people in terms of my tolerance for risk and time. But my attraction to them has to do with the size of the prize and the geological prospectivity more than it has to do with the nature of the activity that they are attracted to. You know, Aditya, my thesis, which is if you have a commodity that is necessary for the living of the lifestyle that humanity enjoys today, where the selling price of the product worldwide is less than the cost of production, which is to say, where the industry is in liquidation, that you have a very, very, very clear a very, very clear buy signal. Industries in liquidation means that the commodity price has to go up. You have no competition on the bid because people don't like to buy industries in liquidation, irrespective of what they see of the future. It's more complex in nickel because you have a new form of lateritic nickel producer in Indonesia that has a radically, radically lower cost structure. My supposition with regards to the laterite nickel is that they don't take into account the full cost of production, which is to say the incredible environmental degradation that occurs as a consequence of that development. As you know, I flew over southern Sulawesi, which is the epicenter of that lateritic nickel production. And I believe with nickel, in terms of nickel laterites, much like I believe with regards to the Western Chinese production of rare earths, that the cost to produce doesn't reflect the true cost, and that the true cost will come to be reflected over time. If I'm right, then we're going to have a very different cost to produce nickel looking in the future.
That leads me well into my next question, which was on rare earths. And I met a few companies that have what we would probably define as top tier assets in the rare earth space in ionic clays. Both companies expressed a view to me, which I thought was interesting, which is that they need a bifurcation of the markets in order to be economic. The market is dominated by China, and China is able to control prices at levels where these projects, despite their top tier status, are still not economic. The table here was from the PFS that was put out by one of those companies, and at current NdPr prices, they have an NPV, post-tax NPV of $16 million.
Right.
Most of the times when we look at PFS studies, we look at it at spot prices as the base case. So here, there's clearly a situation where the base case is entirely uneconomic, and the market is factoring that in terms of what it's doing to their share price today. As a contrarian investor, do you look at this as an opportunity, or is this a red flag for you, where we have these monopolistic supply dynamics which could completely crater the economic case for some of these projects?
Both. I take a considered risk. I believe that as a consequence of the weaponization of rare earths around the industrial processes, that a parallel supply chain likely develops. I also believe this from talking to longtime sources of mine in China, that the cost to produce rare earths in China is increasing rather dramatically. The method of production of the raw material in China has largely been in situ sulfuric acid leach, which has wrought unbelievable environmental problems in far western China, in Xinjiang. We have seen across a variety of Chinese economic activity the fact that the society is becoming rich enough that they and their leadership no longer tolerate the environmental practices that have been responsible for some of China's growth in the last 20 years. So I suspect that a couple things occur. Well, really, I think that three things occur. I think that the underlying demand for rare earths across a variety of industrial applications continues to increase. I think that a parallel supply chain around rare earths will occur. And I think that that parallel supply chain will lower the cost of capital to companies like Meteoric, because I think that there will be official sector participation in non-Chinese sources of supply. And I believe, thirdly, that the cost associated with producing these materials in China will increase more dramatically than most other people believe they will. I don't believe it enough that my participation in rare earths will ever rival my participation in things like oil and gas or gold, where I have a higher degree of certainty.